Everyone thinks trading is unpredictable until they learn to see what I'm about to show you. I'm not talking about guessing direction or timing moves. I'm talking about seeing the same pattern play out again and again because human nature never changes. This rule doesn't come from theory. It comes from experience, from losing, learning, and watching the market repeat the same behavior for decades. In this lesson, I'm going to show you the rule that makes the market predictable not because it tells the future, but because it reveals how human nature always behaves in the face of greed and fear. You'll learn how I used this law to read the market's direction before the crowd, how it guided my timing, and how it kept me out of danger when everyone else was drowning. If you've ever felt like the market moves against you on purpose, like it waits for your trade before it turns, this will change how you see everything. By the end, you'll understand how professionals read repetition, not randomness, and how to use that rhythm to your advantage. I know what it's like to sit there staring at the screen, watching prices jump around, trying to find some pattern that makes sense. You tell yourself the market's unpredictable, that it's all manipulation, all noise. I thought that too. Until one day, after years of frustration, I realized something simple but profound. The market behaves exactly the way people behave, and people crowds are predictable. They react the same way to fear, greed, and opportunity, no matter the year or the technology. Once I saw that, trading stopped being mysterious. Every chart became a story. Every movement made sense. That's the moment I stopped chasing systems and started reading behavior. And from that moment on, my trading became predictable. In this session, I'm going to take you deep into the one rule that made my trading predictable, the law that governs every move the market makes. We'll cover why the market looks chaotic but isn't, how human behavior repeats in waves that can be recognized and traded, how I used this rule to anticipate major turns before the crowd saw them, and how you can apply it to your own trading without indicators, without guesswork, and without fear. But before we begin, I'll warn you, this isn't theory. This is the truth that cost me fortunes to learn. And once you hear it, you'll never be able to look at a chart the same way again. Because what I'm about to show you doesn't make trading easy. It makes it inevitable. So stay with me. By the end of this, you'll see why the market isn't unpredictable at all. It's just waiting for you to understand the rule it's been following all along. Here's something most traders completely miss: the market only looks chaotic when you don't understand what it's built on. When you first sit in front of that tape, or your chart, and you see prices whipping up and down, it feels like madness. You tell yourself it's manipulation, randomness, machines anything except what it really is. But after a while, when you've lost enough money trying to fight it, you start to see a strange order hidden inside that chaos. And that's what I want to show you here. Because the market isn't unpredictable, it's unread by those who don't know what to look for. Now, I know how that sounds. You might think, if it's really predictable, why do so many fail? And I'd tell you they fail because they're watching the wrong thing. They stare at prices when they should be watching people. Every movement on the tape, every spike, every reversal, every quiet lull, it's not a number. It's a reaction, a reflection of someone's fear, greed, or hesitation. When I finally understood that, everything about trading changed for me. I stopped trying to forecast prices and started studying behavior. And once you make that shift, chaos starts to make sense. When I was young, sitting in the bucket shops, I'd write down every quote that came through. I didn't know why. I just felt something in those numbers, a rhythm, a pattern that repeated. I'd watch the same stock rise and fall day after day, almost like it was breathing. It would move up, stall, fall back, and then do it all over again. At first, I thought it was coincidence, but the more I watched, the more I realized it wasn't coincidence. It was human nature. People reacted the same way to the same conditions, over and over, without even knowing it. The names changed, the amounts changed, but the behavior stayed the same. That was my first glimpse into the law behind the chaos. Here's what I discovered. Randomness is just order we haven't recognized yet. Most traders lose because they're too close to the screen. They're watching every tick, every fluctuation, trying to assign meaning to noise. But when you step back, when you start to see the rhythm, you realize the same emotions drive every market in every era. Fear, greed, hope, regret. They haven't changed since men first gathered to trade. The tools change, the tickers get faster, but human nature doesn't evolve. It repeats. And that repetition is what makes the market predictable. Let me give you an example. In every bull market I ever saw, there came a point where everyone, and I mean everyone, was sure the good times would never end. The papers would talk about a new era. Stocks would rise without pause. Even the cautious traders, the ones who used to laugh at speculation, would start saying things like, "This time it's different." And every single time, that confidence turned into overconfidence. That overconfidence turned into leverage. And that leverage turned into disaster. You could almost set your watch by it. It happened in 1907. It happened again in 1929. It's happened 100 times since. The names change, but the cycle never does. That's what I mean when I say the market moves by law, not chance. It's not a law written in numbers, it's a law written in behavior. The law of repetition. The law that says human beings will always react the same way to the same pressures. It's not complicated, but it's invisible to those who are still looking for shortcuts, signals, or secrets. They'll never see it because they're too busy chasing the next thing to slow down and observe what's right in front of them. Now, when I tell you the market is predictable, I don't mean you can forecast every tick. I mean you can recognize the rhythm, the emotional cycle that builds up before every move. You can feel when the crowd is overextended, when fear is replacing confidence, when hope is turning into hesitation. It's not about predicting the next move. It's about recognizing the conditions that make that move inevitable. Once you learn to read those conditions, you stop reacting. You start anticipating. You stop trading against emotion and start trading with it. Think of it like this up close. A heartbeat looks chaotic. The line spikes and dips without pattern. But step back, and you see it follows a rhythm, a pulse. The market's the same way. Up close, it looks erratic. But zoom out far enough, and you'll see its rhythm. Expansion, exhaustion, correction, renewal. The cycle of behavior that's been repeating for centuries. That's the market's heartbeat. And if you can learn to listen to it, you can move with it, instead of being crushed by it. When I started observing this law, my trading transformed. I stopped taking advice, stopped reading tips, stopped worrying about what the papers said. I trusted the tape. The tape told me everything I needed to know, not the why, but the how. The rhythm of buying and selling showed me the crowd's emotion long before the headlines caught up. That's how I learned to anticipate panic before it hit, to sell when others were buying, and to buy when others were too afraid to act. It wasn't magic, it was observation. So here's what I want you to take from this: the market's chaos is an illusion. Beneath it, there's structure. Beneath the noise, there's rhythm. And once you train yourself to see behavior instead of price, that rhythm becomes clear. It's the difference between drowning in the waves and learning to surf them. The waves will always move, that's their nature. But whether you're crushed or carried depends entirely on your ability to read them. And here's what might surprise you: this rhythm isn't something you find through data or algorithms. It's something you feel after years of watching, losing, and learning. It's intuition built on pattern recognition. The market trains you to recognize what fear looks like on a chart, what greed feels like in volume, what hesitation sounds like in silence. Once you've felt those emotions in yourself, you'll see them in others. And when you can see them in others, you can predict their behavior before they act. That's what gives you the edge. So the next time you catch yourself thinking the market is random, remember this: it only looks that way because you're seeing the surface. Look deeper, and you'll find the same emotions repeating the same human rhythm that's been driving speculation since the first trade ever made. That's the law behind the chaos. Once I stopped treating the market as unpredictable and started studying its repeated reactions, I saw something incredible: the same emotional patterns appearing again and again. The crowd panicked the same way, overbought the same way, convinced itself of new eras the same way. That realization became the foundation of everything I ever did as a trader. And that brings us to the next law, the rule of repetition. This is where predictability becomes visible, where you'll see that history doesn't just rhyme, it copies itself. Every rise, every crash, every turning point is born from the same human cycle. And if you can read that cycle, you can see what's coming long before the crowd does. Here's something that might surprise you: the market doesn't change. The names change, the prices change, the technology changes, but the behavior never does. Every panic, every boom, Every rally and collapse, they're all copies of what came before. You can line up the tape from 1907 beside one from 1929 or 2000 or 2020, and you'll see the same emotional rhythm pulsing through them, the same optimism that builds momentum, the same greed that drives it too far, the same fear that wipes it all away. I used to think that each new market was different, that somehow human beings would learn that they'd finally trade with reason instead of emotion. But after a lifetime in speculation, I can tell you with certainty the market never forgets how to fool the majority. And it does so by relying on the one thing that never changes: human nature. What I'm about to tell you might sound simple, but it took me years and countless losses to see it clearly. The market's predictability comes from one law, the law of repetition. Everything that happens has happened before, and everything that's happening now will happen again. The actors are different, the headlines are new, but the play is the same. When you understand that, you stop getting surprised by the market's moves. You start expecting them. You start watching for the signs that always come before a turning point: the arrogance of greed, the silence of fear, the exhaustion of emotion. Those signals are as reliable as sunrise if you know how to see them. Think about how people behave when prices rise. At first, they're cautious. They've been burned before, so they buy small, test the waters. Then prices keep climbing, and they start to believe maybe this time it's real. They buy more. Then comes the news: headlines about prosperity, stories of easy profits, interviews with experts saying the good times have only begun. That's when greed takes over. People stop thinking. They stop asking questions. They start leveraging, borrowing, betting everything on the continuation of what they've already missed. And that's when the trap is set. Because when everyone's in, there's no one left to buy. When everyone's euphoric, the only direction left is down. Then the cycle reverses. A small dip, a bit of bad news, maybe a headline that shakes the crowd's confidence. At first, they call it a healthy correction. But when prices don't bounce back quickly, optimism turns to worry, and worry turns to fear. They start selling, but not all at once. A few cautious ones go first. Then the big holders start to unload quietly while the public still believes the rally will return. When it doesn't, panic sets in. The same voices that shouted buy now whisper sell. And then it happens: the rush for the exits, the selling that feeds on itself, the crash that wipes out months or years of gains in days. The pattern is always the same: greed, overconfidence, denial, panic, despair. And after the wreckage, when prices finally stabilize and start to rise again, the cycle begins anew with disbelief and hesitation. I saw it during the panic of 1907, and I saw it again in 1929. Different decades, same pattern. In 1907, I made my first real fortune because I recognized that repetition. The market had been soaring for months. Speculation was rampant, and the tone on the street was euphoric. I'd seen that tone before. It was the same blind optimism I'd seen in smaller cycles years earlier. I knew it couldn't last. When the break came, I was ready. While the crowd was buying the dips, I was watching for the moment when fear would replace greed completely, the point of capitulation. That's when I struck, shorting stocks as fast as others were begging for margin calls. I didn't predict the panic. I just recognized the pattern that always precedes one. The ocean doesn't change its nature because the tide is high or low. The waves look different, but the motion underneath is the same: ebb and flow, expansion and retreat. The market's the same way. The movements look different up close, but step back, and you'll see it's the same tide of emotion rising and falling. The difference between the amateur and the operator is that the amateur tries to surf every ripple, while the operator waits for the tide itself. Here's something to think about: the crowd's memory is short. Always has been. After every crash, people promise they'll never make the same mistake again. And yet they do. Because they don't study behavior, they study headlines. They look at prices and think the lesson is buy lower, sell higher. But the real lesson is about psychology: how hope blinds judgment, how fear paralyzes reason, how ego destroys discipline. Once you understand that, you start to see that every bull market plants the seed of its own collapse, and every bear market gives birth to the next rise. The rhythm of human nature guarantees it. And that's the beauty of repetition. It doesn't require prediction. You don't have to know when the turn will happen, only that it will. You can watch the signs form slowly, like clouds before a storm. You can see the first gusts of greed, the subtle signs of fatigue in the tape, the way volume spikes when enthusiasm peaks. You can feel it, that shift in tone, the hesitation in momentum. That's when I start watching closer, not for price, but for behavior. Because the first cracks in a trend never show up in price, they show up in attitude. When everyone starts talking about easy money, I tighten my guard. When the crowd stops asking questions, I know the market's about to answer one they won't like. I remember the summer of 1929. I'd seen the same arrogance before. People were borrowing to buy stocks like there was no tomorrow. Brokers couldn't keep up with the demand for margin. I'd seen it all before in smaller manias. The same fever, the same blindness. I wasn't predicting a crash. I was observing inevitability. When the first breaks came, I didn't hesitate. The signs were all there, volume rising on declines, leaders failing to make new highs, optimism refusing to bend. I shorted because history told me what would happen next. I didn't need luck. I had repetition. That's the real edge, not guessing the future, but recognizing the past when it repeats in the present. And here's the truth, it always does. The cycle of emotion, optimism, greed, fear, panic, recovery. It's the law of the market, as sure as gravity. You don't have to fight it. You just have to know where you are in it. The amateur thinks the market is unpredictable because he's looking at isolated moments. The professional knows it's predictable because he's watching the rhythm unfold. So, when you see the crowd celebrating new highs, when every conversation turns to stocks, when caution disappears, remember this. You're watching the middle of the cycle, not the beginning. And when you see silence, despair, and disgust, when nobody wants to talk about the market anymore, that's the start of opportunity. History doesn't repeat perfectly, but it rhymes with precision. The operator's job is to listen for the rhyme. But here's where most traders fall short. They recognize these patterns after they've already played out. They spot the repetition too late. The key isn't just knowing that human behavior repeats. It's learning to identify the repetition before it completes. That's the difference between reacting and anticipating. So let's talk about how to read those clues early. The subtle signals that tell you the crowd is about to repeat itself. The early tremors before the quake. The shift in tone that precedes the storm. That's what separates the gambler from the operator. And it's what will make you see the market with new eyes. If you've been in this business long enough, you start to feel the pulse before you see it. The crowd always reveals itself before the move comes, not in price, but in behavior. The signs are there, scattered across the tape like footprints before a storm. Most people miss them because they're too focused on what they hope will happen, instead of what is happening. But once you train your eye, once you slow down enough to observe, you'll begin to recognize those early clues that tell you the same play is about to run again. And that's when the market stops being mysterious. The first thing I learned was that greed always shows its hand early. When a market is rising, there's a natural rhythm to it, at first a smooth, confident climb. But then something changes. The moves get steeper, the volume gets louder, and suddenly everyone becomes an expert. The same people who swore off risk 6 months ago start talking about how this time is different. They speak with authority about things they don't understand. I've seen it in every mania. From steel to rails, from cotton to tech stocks. You'll know greed has arrived when caution becomes unpopular. It's in the tone of conversations, in the laughter around the ticker, in the way everyone stops asking why and starts saying how high. I remember in the late stages of a bull market, brokers would practically beg me to buy. Their clients wanted to be in everything. Men who'd never speculated before were borrowing money to get a piece of the action. The papers would run headlines about new millionaires, new records, new eras. When I saw that, I didn't need charts to tell me the end was near. I knew the crowd had entered its final phase, the point where conviction becomes overconfidence, and overconfidence becomes self-destruction. The signs were always the same: wild optimism, record volume, and that dangerous feeling that nobody could lose. The market doesn't forgive that kind of arrogance. The same principle applies on the other side. Fear is just as visible. It's quieter, but no less predictable. You can feel it in the silence of the tape, When traders stop buying dips, when volume dries up, when people who once bragged about their profits now say nothing, that's the whisper before the panic. You'll hear it in their words. I just need to get back to even. You'll see it in their actions, selling good stocks to cover bad ones, hesitating to take small losses until they become large ones. I saw it countless times, and it always meant the same thing. The market was bleeding out emotion, preparing for the reversal. There was a time, I remember it vividly, in the months before the great crash of '29, when I'd walk down Wall Street and feel the heat of speculation in the air. It was intoxicating. People weren't thinking anymore. They were betting. The leaders, the strong stocks, started to stall. The advances were narrow. You could feel the rhythm faltering. The tape was telling me that the crowd's appetite was overextended, that the same pattern I'd seen in 1907 was repeating. That's what I mean when I say the market has a memory. It doesn't remember prices, it remembers behavior. The way it moves when people lose all restraint. The way it breathes when fear begins to choke greed. Those reactions are the same in every generation. So how do you recognize these repeats before they happen? You start by detaching yourself from the crowd. You can't study behavior if you're part of it. You must step back far enough to observe it without emotion. That's why I always worked in silence, away from the noise of opinions and rumors. I wasn't looking for tips, I was listening for tone. When people are calm, their tone is measured. When they're greedy, it becomes excited. When they're afraid, it turns defensive. You can hear the market's emotional temperature if you're quiet enough. The tape itself has a tone. The volume, the speed, the reactions, all of it speaks. Then, you watch how the market reacts to news. That's one of the clearest tells. A healthy market ignores bad news. A weak one overreacts to it. Before every major turn, I saw this shift. In the late stages of a bull run, good news stops moving prices higher, it's already priced in. Then one small piece of bad news triggers a larger than normal drop. That's not the news causing the fall, that's the exhaustion of buying power. The crowd has spent its ammunition. On the way down, the opposite happens, bad news loses its bite, and prices stop falling on panic. That's when I know the bottom is near. It's the same pattern every time. The market always tells you what's coming through its reaction. That's how I built my market key, a mental checklist of behaviors that repeat before every major move. I'd watch for the leaders to falter, for volume to surge and then fade, for the public to rush in late, for the tone of the tape to turn heavy. When those signs lined up, I didn't need to guess. I didn't need to predict. The repetition told me everything. The tape was my teacher, and every lesson cost me something. But what I learned was invaluable. The market doesn't hide its intentions. It whispers them to those who are willing to listen without emotion. Here's an image I often use. Imagine standing on the deck of a ship before a storm. You can smell it before it arrives. You feel the air change heavier, charged. The ocean goes quiet for a moment, almost too calm, before the first gust of wind. That's what it feels like before a market turn. There's a tension in the air, a sense that something's off. The noise doesn't vanish, it just changes pitch. The crowd feels it too, but they mistake it for opportunity. They buy more, certain they can't be wrong. And that's the exact moment the tide turns. The great advantage of repetition is that it rewards patience. You don't need to act constantly. You only need to act correctly. If you wait for the cycle to reveal itself, for greed to become visible, for fear to thicken in the air, you can move with precision while others are blind. That's what speculation really is, waiting for the crowd to do what it always does, and then taking the other side when emotion peaks. It's not about forecasting. It's about recognizing the inevitability of repetition. Now, let me tell you something that might sting. You are not immune to these emotions. None of us are. The market doesn't just reveal the crowd's behavior, it reflects yours. That's where the danger begins. Because if you don't master your own repetition, the habits, the impulses, the same mistakes you make again and again, the market will use them against you. Every trader becomes a pattern in himself, and the market reads that pattern better than he does. I've seen men lose fortunes not because they couldn't read the market, but because they couldn't read themselves. And that realization changed everything for me. I stopped blaming the market for being unpredictable. I started looking at how predictable I was, how often I'd buy too early, hold too long, ignore the warning signs I'd learned to recognize in others. It was humbling, but it was also liberating. Because once I saw that my emotions were part of the same cycle, I could control them. I could step outside myself and observe calm, detached, like a man studying the crowd from the balcony instead of being crushed in the stampede below. That's when predictability became real, not just as a concept, but as a skill. The market's behavior was no longer mysterious, because mine wasn't. That's what separates the operator from the public self-awareness. You can't control the market, but you can control your reactions to it. And once you do that, you begin to see repetition everywhere, not as danger, but as opportunity. So now, let's move deeper. Because the same emotions that make the market predictable, greed, fear, hope, are the same emotions that make you unpredictable to yourself. And unless you learn to master that mirror, no law, no system, no rule will ever save you. You can read every chart in the world, but until you can read your own reflection, you'll keep repeating the same mistakes the crowd does. Here's the part of speculation that no one wants to face. The market isn't your opponent, it's your reflection. Every chart you look at, every entry you make, every hesitation, every loss, it's all a mirror showing you the same patterns, not in price, but in yourself. I didn't understand this for a long time. Like most traders, I thought the market was out to trick me, that it was personal, that it waited for me to act before it moved the other way. I'd curse the ticker, blame manipulation, blame luck, blame timing. But none of that was true. The market wasn't punishing me. It was teaching me. It was holding up a mirror and asking, "Do you see yourself yet?" When you look at a market that feels unpredictable, what you're really seeing is your own emotion projected onto it. The confusion you feel comes from inside, not from the screen. That's why two people can look at the same setup and one sees opportunity while the other sees danger. The difference isn't the data, it's the discipline. One man sees what is, the other sees what he wants. That's the entire game right there. The amateur trades opinion. The professional trades observation. Until you learn to separate the two, the market will always feel like chaos. I learned this lesson in one of the most painful ways possible, through my own predictability. There was a time I was long wheat and cotton at the same time. Wheat started to rise, cotton started to fall. Instead of holding on to the winner and cutting the loser, I did what every emotional trader does. I sold the wheat to lock in my profit and held the cotton, telling myself it would come back. That was the moment the mirror showed me exactly who I was. Hopeful when I should have been fearful. Fearful when I should have been calm. The wheat kept climbing, and the cotton sank deeper. I didn't lose just money that day. I lost the illusion that I was in control. Because the truth is, I wasn't trading the market, I was trading my own fear. That mistake taught me something I never forgot. The market exposes your weaknesses faster than anything else in life. It doesn't give you time to hide them. Every decision is immediate feedback. You think you're patient, the market will test your patience. You think you're disciplined, it will tempt you to break your rules. You think you're calm, it will shake you until your heart pounds in your throat. That's what makes it so cruel and so honest. It's the perfect psychological instrument. It measures who you really are, not who you pretend to be. And here's the hardest truth: you can't outsmart your own emotions. You can't reason your way out of fear or greed when they're in control. The only way to master them is to face them, to observe them, to accept that they exist and that they'll never disappear. You don't eliminate emotion. You discipline it. You learn to trade with it sitting quietly beside you, like a wild animal that you've tamed but never trust completely. That's why discipline isn't just a trading skill, it's survival. When I began to understand this mirror principle, I stopped looking outward for explanations and started looking inward. Every loss became an investigation. Why did I hesitate? Why did I overtrade? Why did I take that profit too early or let that loss grow too large? The answers were always the same: impatience, hope, ego, the same three shadows that follow every trader who refuses to see them. And the strange thing was, once I began studying my own reactions the same way I studied the tape, I noticed something. My emotions followed the same patterns as the market. I had my own cycle of greed, fear, hope, and regret. My moods rose and fell just like prices did. I was my own trend. And until I learned to read that trend, I couldn't read anyone else's. The more I studied myself, the more predictable I became, not to the market, but to myself. I began to recognize the feeling that came right before a mistake, the slight urgency in my pulse, the need to prove something, the desire to make back what I'd lost. That was my warning signal, my own internal tape whispering, "You're not calm, don't act." Once I could see that, I stopped being blindsided. I could stand aside when I was emotional, trade only when I was clear. That's what real predictability is, not knowing what the market will do next, but knowing what you will do next, regardless of it. You might think that sounds like restraint, but it's actually freedom. When you're disciplined enough to observe yourself without interference, you stop being a victim of your impulses. You stop taking random trades because you're bored or afraid of missing out. You stop needing the market to validate your worth. You start waiting for conditions to align because you finally trust your method more than your emotion. That's the point where trading stops being chaos and starts being precision. The greatest advantage I ever gained wasn't my system, or my capital, or my experience. It was detachment. I learned to stand outside myself. I became both the trader and the observer, watching my own mind the way I watched the ticker, looking for rhythm, for behavior, for repetition. When I caught myself breaking a rule, I didn't justify it. I noted it. I studied it. I treated it like data. That's what turned emotion from an enemy into a teacher. The market punishes blindness, but it rewards awareness. You can't read the market clearly until you stop projecting your own story onto it. Every time you think, it has to go up, or it can't go lower, that's your ego talking, not the market. The market doesn't have to do anything. It moves in response to the same behavioral forces that move you. And if you learn to recognize those forces inside yourself, the excitement that precedes greed, the hesitation that precedes fear, you'll start seeing them everywhere in price action. The tape becomes a mirror of mass emotion, and once you see that, it becomes predictable, not because the future is known, but because human reaction is. This is the point where most traders resist. They don't want to face the mirror because it's uncomfortable. It's easier to blame the system, the brokers, the news, the manipulation, anything but themselves. But those excuses are what keep them trapped in the same cycle, reliving the same losses in new forms. The only way out is inward. Once you strip away the noise and the excuses, you're left with one simple truth. The market behaves predictably because you behave predictably. Break your own pattern, and you break the market's hold over you. I used to say, the market is never wrong, opinions often are. What I meant was this: your opinion, your interpretation, your desire, they mean nothing. The tape doesn't lie. It just records the truth of behavior, yours and everyone else's. When you stop trying to argue with it, when you stop trying to force it to match your beliefs, it rewards you. The man who accepts the mirror learns faster than the man who denies it. And that's why I isolated myself from the crowd. I didn't want their noise contaminating my reflection. I wanted to hear my own thoughts clearly, to know whether what I was seeing was real or imagined. In those quiet mornings before the market opened, I'd review my plan, my positions, my state of mind. If I felt anxious, I didn't trade. If I felt overconfident, I cut my size. If I felt nothing, calm, steady, detached, that's when I knew I was ready. That ritual became my discipline, my anchor in the storm. It kept me balanced when the crowd lost its mind. You see, discipline isn't a punishment. It's the structure that keeps your freedom intact. It's the framework that prevents your emotions from hijacking your judgment. It's the only thing separating a professional from a gambler. And the moment you treat discipline as a burden instead of a safeguard, you're already losing it. So understand, this predictability begins with you. You can't see order in the market until you create order in yourself. You can't anticipate behavior until you've studied your own. The more disciplined your mind, the clearer the mirror becomes. And when the mirror is clear, you can finally see the market as it is, not as you wish it to be. Now, once you reach that point, something remarkable happens. You begin to notice a deeper rhythm beneath everything, a pulse that connects time and price, a sequence so steady that it feels like music when you hear it correctly. That's where predictability stops being psychology and becomes precision. It's where the emotional patterns you've mastered give way to technical ones you can measure, anticipate, and act upon with confidence. That's the next level, the rhythm of time and price. When I finally quieted my mind enough to see clearly, I began to notice something deeper than emotion or crowd behavior. Beneath every movement of fear and greed, there was a pulse, a steady rhythm that connected time and price. It was as if the market itself breathed in cycles, expanding and contracting in perfect sequence. It took me years to recognize it, because I, like every trader at the start, was too busy chasing the noise. But once I began to observe the market with calm attention, without forcing my opinion on it, I could sense it a repetition, not just in behavior, but in the passage of time and the progression of price. And that rhythm became my compass. It told me when to wait, when to act, and when to disappear. Every move in the market takes time to build before it takes price along with it. That's something most traders never understand. They want instant results. They want a stock to move the moment they buy it, or they assume they're wrong. But the market doesn't move on your schedule. It has its own. Every trend, every reaction, every reversal must go through its natural time element. That's why I learned to respect time as much as I respected price. When you learn to do that, trading stops being impulsive. It becomes patient and precise. I used to sit for hours just watching the tape, not trading, not thinking about profits, just listening. The tape would move fast, then slow, then fast again. It had a tempo, like a metronome. I realized that before every major move, the market first needed to rest, to consolidate, to build pressure. That resting period was the market gathering strength. I saw it happen countless times. Stocks would move up, pause, drift sideways while everyone lost interest, and then suddenly explode in the original direction. It wasn't magic. It was timing. The market was catching its breath. The amateurs would call that stagnation. The professionals knew it was preparation. That's the mistake most traders make. They confuse stillness for weakness. But stillness is where the next move is born. When I say time precedes price, that's what I mean. Every price expansion begins with time compression. Every explosion starts with silence. You can't predict the future, but you can recognize the setup. When a stock stops, reacting to bad news, when it refuses to fall further despite pressure, it's telling you something. It's building time. And when time and price finally align, when the waiting is over, that's when predictability turns into profit. I remember before the Great Panic of 1907, I watched the market move in slow exhaustion. The big leaders began to falter. Their rallies became weaker, shorter, more forced. Volume would surge at the open, then fade. It wasn't obvious to the crowd. They were still celebrating, still buying every dip. But to me, the rhythm had changed. It was like hearing a song that suddenly lost its tempo, offbeat, unsteady. That was the signal. Time had run out. I didn't need a headline to confirm it. The tape told me everything I needed to know. When the panic finally came, I wasn't surprised. I'd seen it unfold in slow motion for weeks. That's what separates the observer from the participant. The participant reacts. The observer anticipates. When you understand rhythm, you stop trying to predict and start letting the market reveal itself. You don't force trades anymore. You wait for time to do its work. You watch price confirm the buildup. And when it finally breaks, you act decisively, not because you guessed, but because you recognize the rhythm that always comes before a move. You can think of it like music. Every great composition has silence between notes. Without that space, it would be just noise. The market works the same way. Those pauses, those stretches of indecision, are where the next movement is composed. Most traders can't stand silence. They trade to fill it. But if you can learn to listen, to sit in the quiet moments of the market without anxiety, you'll start to hear its melody. And when you can hear that melody, you'll never need to guess again. So how does this rhythm reveal itself in price? Simple, through reaction. Price confirms the story time has been telling. The move doesn't. When you enter it. Begins when the market proves your thesis right. That's why I never added to a position unless the market moved in my favor. I didn't trust opinions. I trusted proof. A market that rises after you buy it is confirming your read. A market that hesitates or reverses is denying it. It's that simple. Confirmation is the market's way of saying, "You've understood me correctly." That's why I always waited for strength to prove itself before committing my full capital. I'd take an initial position, small, deliberate, and then wait. If the market moved my way, I'd add in stages, each addition smaller than the last. If it didn't, I'd cut it without hesitation. That was my law of confirmation. You only build when the market confirms your read, never before. It's one of the hardest rules to follow because it goes against human instinct. Most people want to prove themselves right. They add to losing positions, convinced the market will turn to vindicate them. But the market doesn't reward pride. It rewards alignment. You can't force alignment, you can only wait for it. I used to say that the tape tells the truth long before the headlines do. That's because price is behavior, and behavior is predictable. When I saw a stock refusing to drop on bad news, I knew strength was hiding underneath. The crowd saw weakness. I saw accumulation. And the reverse was true as well. When good news failed to push prices higher, I knew distribution was underway. The market was handing the bag from the professionals to the public. That's how I avoided traps, not by guessing the future, but by reading reactions. The crowd reacts emotionally. The operator reads those reactions calmly, like studying the pulse of a patient. That's the heart of predictability, not foresight, but observation. You don't need to know what will happen next. You only need to understand what's happening now. When a market behaves differently from how it should, it's revealing its true direction. The more you trade, the more sensitive you become to those shifts. It's like watching a river's current. You learn to see the subtle changes in flow long before the water turns violent. So, remember this. The rhythm of the market is constant. Time builds, price confirms, reaction reveals. That's the sequence. That's the song. If you can train yourself to follow it patiently, without interference, you'll begin to move in harmony with the market instead of against it. That's what professionals do. They don't rush. They don't panic. They wait for the rhythm to align with their plan, and then they act once, decisively. And once I began to see that rhythm clearly, I stopped fighting the market altogether. I stopped trying to make it conform to my will. I let it lead. I let it show me when to step in and when to step away. That's when trading became effortless. Not easy effortless, because effort comes from resistance, and there's no resistance when you're in tune with the rhythm. But here's where most traders fail. They can recognize the rhythm, but they can't wait for it. They see the setup forming and jump too soon. They mistake anticipation for action, and in doing so, they break the rhythm themselves. That's why the next great challenge isn't in seeing the market's pattern, it's in mastering the patience to wait for it to complete. Because knowing isn't the same as doing. The market rewards those who can sit still when everyone else is restless. And that's where we go next, into the discipline of waiting. The final test of predictability isn't recognition, it's restraint. To see the rhythm is one thing. To trust it enough to wait for the perfect moment to act, that's mastery. Here's something that took me a lifetime to learn. Most of the big money I ever made came not from what I did, but from what I didn't do. Every trader wants to act. Every trader feels that if they're not in the market, they're missing something. But the truth is, in speculation, doing nothing is often the most powerful move of all. The reason most men fail isn't because they can't find opportunities, it's because they can't wait for them. They mistake motion for progress, and they confuse action with intelligence. I learned the hard way that the real professional isn't the man who trades the most, it's the man who sits the longest when the time isn't right. When I say waiting, I don't mean laziness. I mean deliberate observation. I mean watching without interference, studying the rhythm until it aligns perfectly with your rules. That's what I called sitting tight. It's the most unnatural discipline for a human being, because our instinct is to act when we feel uncomfortable. And in the market, you'll feel uncomfortable most of the time. The price moves without you, and you tell yourself you're missing out. You feel that itch to do something, to prove you're not being left behind. That's the trap. The market wants you restless. It feeds on your impatience. It waits for you to act before it moves the other way. The only way to beat that design is to become indifferent, to sit so still that the market forgets you exist until it's ready to invite you in. There were days, weeks, sometimes months, when I'd do nothing. I'd sit there with my hands in my pockets, watching the tape scroll by, and people would whisper, "Livermore's lost his nerve." But I hadn't lost nerve, I'd found clarity. Because I understood that opportunity doesn't arrive on your schedule, it arrives on the markets. And if you try to force it, you'll be right occasionally, and broke eventually. You can't make the market pay you on command. All you can do is prepare yourself for the moments when it's ready to pay you, and those moments are rare. It took me years to accept that doing nothing was a strategy, not a weakness. Early on, I'd jump at every signal, every setup that looked promising. I'd enter trades half a beat early because I was afraid of missing the move, and I'd watch as the market corrected itself and took my money before the real move began. I was like a man firing before he'd aimed. Then one day, I realized something simple: the market always gives a second chance. If you miss the perfect entry, don't chase it. Wait for the next one. The rhythm always returns. There's no need to rush when you understand that time creates opportunity as reliably as price does. I remember sitting through an entire summer once, years before the panic of 1907. The market was dull, sluggish, lifeless. Men around me complained there was no action. They forced trades to cure their boredom. Every one of them lost. I did nothing. I watched. I listened. I waited. I knew that stillness was not emptiness, it was the market building its next move. When the panic finally came, I was ready. I'd preserved my capital, my focus, and my nerve. While the others were exhausted from chasing noise, I was fresh and calm. That's when I struck, and that's when I made my first real fortune. That's what patience gives you: not just capital, but composure. It keeps your judgment clean. The man who trades every day is like a gambler pulling the lever again and again, hoping for luck to rescue him from his mistakes. The man who waits is an operator, deliberate, observant, and detached. He knows that every unnecessary trade dulls his edge. The market rewards restraint more than brilliance. The quieter your mind, the sharper your timing becomes. Most traders can't handle quiet. They can't bear the boredom. But boredom is the price of discipline. The professional embraces it because he understands what's really happening during those quiet periods. The market is resetting, rebalancing, purging excess emotion. Every phase of inactivity prepares the ground for the next burst of movement. That's why I learned to love the dull days. They were my training ground. They tested whether I could sit still while others lost control. When I talk about sitting tight, people think it only applies to holding winning positions, but it applies just as much to waiting for them. The big money isn't in buying or selling, it's in the waiting before you buy and the sitting after you've bought. Every trader wants to act, but very few know how to wait with purpose. The amateurs see waiting as wasted time. The professionals see it as the only time that matters, because that's when you're not losing money. That's when you're watching, thinking, refining, preparing. Let me tell you something true. Every great trade I ever made looked obvious in hindsight, but invisible in real time. Why? Because I only acted after long, silent observation. I'd watch the same stock for months, waiting for the tape to prove it was ready. And then, when everything aligned, time, price, rhythm, behavior, I'd strike. One decisive action, born from weeks of waiting. That's not luck. That's the reward of patience. So if you want predictability, learn to do what almost no one else can: sit still. Don't chase the market. Let it come to you. Observe it like a hunter in the woods, quiet, invisible, waiting for movement. The impatient man lunges at shadows and goes hungry. The patient man waits for certainty and feeds for a season. That's the power of inaction. And once you've learned to wait without frustration, once you've learned to let the market unfold instead of forcing your will upon it, you've taken your first real step toward mastery. But there's one more test ahead, because it's not enough to wait. You must also trust what you've waited for. You must believe in your setup enough to act when the moment finally arrives, without hesitation, second guessing, without fear. And that's where the next lesson begins. There's a moment every trader faces: the point after all the waiting, after all the studying, when the market finally begins to move the way you've been expecting. That's when doubt creeps in. You've done everything right, you've been patient, you've read the rhythm, and yet, when the time comes to act, your hand hesitates. You start second-guessing your judgment, wondering if this is just another false start, another trap. You tell yourself, maybe I should wait a little longer. Or worse, you act too soon because you're afraid of missing it. Either way, hesitation or haste both destroy timing. That's why patience means nothing without trust. You can spend weeks waiting for the right moment, but if you don't believe in your setup when it finally arrives, all that discipline turns to dust. Trust isn't faith, it's familiarity. It comes from preparation, from knowing exactly what you're looking for. When I sat alone in my office, long before a campaign began, I'd write out every scenario I could imagine. I'd map out what I'd do if the market went up, if it went down, if it stalled. I wanted no surprises. I didn't want to think on the fly. Thinking during a trade is the most expensive kind of thinking there is. You do your thinking before the bell rings, and then you execute like a machine. That's where trust comes from preparation so thorough that action becomes automatic. When I'd see my conditions align the rhythm of time, the confirmation of price, the reaction of behavior, I didn't hesitate. I acted because the setup had already proved itself. And if it didn't work, that didn't shake me. Because my trust wasn't in any single trade, it was in my process. Most traders fail not because their ideas are bad, but because they abandon them the moment they face doubt. They don't trust their preparation. They let emotion override the plan they built in calm. And that's the difference between an operator and an amateur. The amateur trades emotion, the operator trades structure. When I'd enter a position, I didn't question it after the fact. The moment you start wondering if you should have done something different, you've already lost control. You must decide before you act that you will trust your decision completely. That doesn't mean being stubborn. It means having conviction in your plan and the humility to follow it. If it fails, you exit. You don't argue with the tape. You just move on. But you never abandon the process, because if you abandon your structure once, you'll do it again. And each time you do, you move further from predictability and deeper into chaos. I remember one campaign where I waited nearly half a year before entering. The stock had been consolidating, building energy. The chart looked quiet. The tape was dull, but the rhythm beneath it was tightening. I could feel the pressure mounting. Then one day, volume surged, price broke through resistance, and confirmation was there. Everything aligned. I entered immediately, no hesitation. The crowd didn't understand. They thought I was lucky. But I wasn't lucky. I was ready. I'd been waiting for that signal every day for months. The moment it appeared, I recognized it instantly because it looked exactly like every other true move I'd seen before. That's what preparation gives you: recognition. And recognition gives you confidence. You see, trust in trading doesn't come from certainty. It comes from consistency. You'll never be certain, but you can be consistent. The crowd wants guarantees. Professionals want probabilities. I never expected every trade to win, but I expected every trade to be right in principle, right in process. That's how you win in the long run. You can't control the outcome, but you can control your behavior. And if you behave consistently according to tested principles, the results take care of themselves. There's a kind of quiet strength that comes when you finally stop doubting your own structure. You no longer need reassurance from anyone, not from tips, not from opinions, not from the noise of the crowd. You know what you're looking for, and you wait until you see it. When it appears, you act cleanly, without drama, without excitement. You don't feel thrill or fear. You feel alignment. That's what real trust feels like. It's calm, not confidence. It's clarity, not courage. Traders who don't trust their setups live in constant tension. They enter too early, exit too late, chase after reversals, and blame the market when it punishes them. They tell themselves they just need better information, better tools, better indicators. But the problem isn't the market. It's their lack of faith in their own preparation. They haven't built enough experience to believe in their method. They haven't earned the right to trust themselves. That's why I always told younger traders, don't look for better systems, build better discipline. Because once you trust your process, predictability appears not as something external, but as a reflection of your internal order. And that's where freedom begins. When you trust your setup, you stop feeling the need to act all the time. You know exactly what you're waiting for, so you don't waste energy chasing everything that moves. You can watch the market without being pulled by it. You can sit still when others are panicking, and you can strike when others are frozen. Trust gives you patience, and patience gives you precision. The man who waits without trust grows anxious. The man who trusts what he's waiting for grows powerful. When you've prepared properly, when your plan is written, when your rules are firm, and your patience has ripened, that's when the market's rhythm and your rhythm become one. You no longer force decisions. They happen naturally. That's what I meant when I said the big money isn't in the buying or selling, but in the waiting. It's the waiting that creates readiness, and it's readiness that breeds trust. You can't fake it, and you can't rush it. You earn it through repetition, through trial and error, through every loss that teaches you what not to do. So, if you've been patient, and the signal comes, act. Don't let fear disguise itself as caution. Don't let doubt steal the reward your patience has earned. You've done the work. You've studied the rhythm. You've seen the alignment. Now it's time to trust it. Because hesitation is as costly as haste, and indecision is the most expensive position in the world. When you reach this point where patience meets conviction, that's where you stop being a participant and start being a professional. Because the market doesn't reward those who try to outthink it. It rewards those who operate with order amid uncertainty. And that's exactly where we go next.